That's it. Where's the liquidity? Where's the inefficiencies? And what day of the week is it? And where are we at in the daily range, time-wise? That's all that matters, because the algorithm only cares about that. It doesn't care about your Ichimoku position based on a cloud, based on a candlestick pattern, based on a moving average crossover, based on an overvaluation or an undervaluation of an indicator that absolutely has no bearing on what price is going to do. If there's nothing new under the sun, why is all these new forms of indicator keep coming out? Again, you're trying to stretch something to comfort you because you're seeing shit that shouldn't exist. I told you I had to do it wrong, baby. I had to do it wrong. But see, you don't believe it. You don't believe it because it's too good to be true. And I take that as a compliment. Thank you. Thank you, detractors. Thank you, doubters. Thank you, people that call me a scammer. I love it because without you, the people learning and seeing in their own hands wouldn't be even more motivated by it. You not having said so. That's like a pinch to them that, yes, this shit's real. And yes, you are being cut out of a mold that few people can press themselves into. See, you have this normalcy bias, folks, that you deny me, you deny what I teach, and deny what I prove. Beyond a shadow of a doubt. I'm out here where I have to be right. Not you as a student. You don't have to be right. See, the people that sell mentorships, they love the idea that I'm trying to teach you to be right. No, I'm teaching you how to operate and not demand perfection and still be profitable. But daddy can walk this shit every day and come home a winner because it's my stuff. It's mine. I know when they're going to work and when they're not really going to work. I know that. What I don't know is when they're going to step in and intervene manually. And I have protocols and procedures for that. I know where I'm likely to fail. I know I know buying during a protraction where the market's going to reach down into a lower PD array for a discount, then go higher. Well, that makes a perfect scenario to go in there and do, I'm going to go long here and put a very, very small stop loss, extremely small, so that way it looks like I messed up. And the trolls get fever pitched and salivating, they can't wait. Oh, look at this guy. He invented the algorithm. He took a loss. And then I really shunned the waters. Oh, took another loss. Look at that. Look at that. And then it delivers. Then it delivers. It was right. Look at the first presented fair value gap on Monday. Look at Tuesday's first presented fair value gap. Wednesday's first presented fair value gap. Thursday's first presented fair value gap. From morning and PM session, and see what opportunities were available to you. The new week opening gaps over the last 5 weeks, how were they used? See, folks, there is absolutely something new under the sun. I have so many things to share. Give me a number 1 with a plus symbol after it if you would like to hear me tell you in the next 5 minutes when to anticipate smart money divergence. SMT, smart money tool, smart money technique. I never settled in on a name on it. I can't see your posts because I'm walking around the house. So I'm hearing some things blinking and blipping in the background, so I'm assuming that you probably are doing that now. When you see a market move into a macro, now a macro is me showing you how it's been codified, coded, scripted to run for inefficiency or liquidity. That's what that 20-minute interval every single hour, it does this. Now, if you understand that that is where price is going to seek to jump to reach for, to draw towards, move in the direction of a obvious inefficiency above or below the market, or an obvious relative equal, high or low, or a singular high or low, like a London session high or a London session low. Sometimes they're not always a relative equal low or relative equal high. In London session, that one we treat a little bit differently because it can be a singular high, not relative equal highs. So a SMT divergence will form usually just before the delivery from a macro. So in other words, you're going to get that price run high. Like imagine for a moment, the market's been rallying and it goes up, creates a short-term high, and it trades off. And we'll say we're watching the NQ, NASDAQ. And then some period of time, and I'll leave that up to the time frame you're looking at, because this forms on every time frame. And then it rallies up and makes a slightly higher high than the previous high in NASDAQ as we approach the beginning of a macro time. It can happen inside of a macro time. If it does, then it's super fucking star. It's gonna rock. It's gonna be a rock star performance because you got best of both worlds right there at the same time. But usually SMT will form just before a macro. And that stop hunt is the damage that frees the market to deliver under the basis of that macro time. Because the macro is where all traffic is removed. It's like when air traffic control says, okay, we cleared airspace, you have the right to have a safe landing here on runway so-and-so. That's what a macro is. It's air traffic control to allow all things get the fuck out of the way. Now we're going to the liquidity or the inefficiency above or below the marketplace. The SMT divergence is the damage before that's permitted. So Larry Williams did not fucking teach that. He doesn't even believe the things, like he thinks that there's no them against us. And that's where we defer. Like that was the separation point with me, because I love him to death. I'm so thankful. I'm absolutely thankful that I was exposed to his stuff, and it came by a mailing list. I didn't find him any other way. Because I bought books from Trader's Library and had it mailed to my house. I was placed on a mailing list, and I got a hold of Ken Roberts' shit too. So it could have been from his mailing list, because he was selling the mailing list if everybody bought his course. So one of those two, I was placed on a mailing list that Larry Williams purchased, and then he direct marketed his course stuff, and I started buying it. And when I got to the point where I started seeing that there's measures of manipulation here that I can't escape. It's there. I don't know what's going on, but I know it's going on. And I do think it's a them versus me. They're stopping me out. I'm on the right side of the trade. And if I was not stopped out, it was going to go to my target, and I would have had the full run. I learned that real quick in my development, but I couldn't overcome it. I couldn't see it. So when I started looking for time cycles, and don't take that out of context, people are going to use that sign that right there. I don't believe in time cycles. Okay, but when I started looking at Fibonacci time, when I started looking at the element of repeating phenomenon, I didn't go in looking for it to occur at the same times. I just went in there looking for data. And I started seeing this overlap of everything in the British pound futures, everything in the Deutsche Mark futures, and Swiss franc futures. And then I started seeing it in the bond market. Now I transitioned to trading just the SPOOS market, because I didn't trade NASDAQ back then. It was just the S&P market. It was happening there too. And I was like, shit, well, let me just streamline this and get it down to a window of time where I only want to be focusing on setups to form right here and there. And that was the beginning of the macro. And that's why I've encouraged you last week, look at a 15-second chart. Look for relative equal highs and relative equal lows, because if you study them on a 15-second chart, you're going to watch how the market goes back and forth and bangs them, back and forth, bangs them, bang and bang. And you can literally sit there all day long and trade a 15-second chart, and everybody else calls it noise, but it's just literally like just anything else. The time frame is very short. You got to be nimble. And you can learn a lot by tape reading a 15-second chart, even if you can't trade the lower time frames. So many people they're just adamant about, no, I need you to start teaching me on a 4-hour chart, daily chart, or weekly chart, or I'm not interested. Then get the fuck out of here. Because you're literally that guy coming to the Jade Master saying, I'm not learning anything. When the 15 seconds doing every fucking thing that a weekly chart, a monthly chart, a quarterly chart, a yearly chart, 5-year chart, doesn't matter what the fuck it is, it's price. But you're getting so many wonderful examples that repeat inside of just a 1 hour chart. 15 seconds is a lot of opportunity to see it banging around and take relative equal highs and relative equal lows and noticing the time that it forms these things. And I promise you a revelation in that, because you will see how one of the most used high frequency trading algorithms operates in the marketplace every single day, buying and selling all day long. You see it clearly on a 15-second chart, 30-second for some of the more significant price runs, but the real detail, you'll see it in a 15-second. And I don't want you to take my word for it. I want you to go out there and spend some time delving into that, and you will find what you realize after seeing it. That's what goes on behind the scenes. It's they're running the price on a scripted basis, and it's on time. If it's not ran by time, you're going to have a random distribution of when relative equal highs and lows are being taken out. But you're not going to see that. You're going to see that they happen at a conformed window of time. Now, right away, that's toxic to some of you. Like, no, you should just tell me what it is. No, I shouldn't. I shouldn't be telling you any of this stuff. If we're being honest, you're not entitled to this stuff. But you have a wonderful revelation if you do that. I'll share with you 15-second charts for the people that don't have that chart. I'll share the morning session through the guise of a 15-second chart next week, this starting this week. And that way you can look through the chart and study it. And you'll see it. You'll note it. And once you get that, the whole idea of this market being scripted or there is no central algorithm, you're full of shit, man. Every instrument has an algorithm price engine that literally drives the market up and down, and it attacks resting orders. It entices buying and selling. There's no buying and selling pressure driving it up. No more than the 3 or 4 ticks above the high that has a standing base of orders, maybe in tune of 250 contracts. But 2 ticks above that, there's another 300 handles, 500 handles, 10 handles above that, but it stops just above to bump those, leaving all that real juicy liquidity. You mean tell me that nobody's interested in being a buyer? That they can't just rebook and send that price higher to higher to higher just to absorb that liquidity up there? They don't want it there. That's why it never goes there. It's controlled. They leave that up there because when they start sinking the market, more shorts are going to enter the market and that liquidity increases. Because what you're watching is the net longs that the smart money's holding, they need to exit the liquidity to exit out of that. So they want to build these big pools of liquidity above old highs. That's why turtle soups work. That's why they work. Linda Rash's book never covers that, and you can go and look at her book. Look and see if Larry Connors and Linda Rash mentioned that's the reason why the turtle soup forms. They just say they're capitalizing on a pattern that historically has been proven 70% effective by being contrarian to what the turtles traders methodology was, which was buying a breakout of 20-day highs and lows. You ever seen me using a 20-day high and low? Fuck no. But the concept of a false breakout, which I didn't invent that. They didn't even invent that. They just gave you a specialized system of entering around that idea or premise, which is why I think the book was great when I first got a hold of it. I paid $175 for that book. I don't know what it goes for now, but I don't regret paying that much for it because it gave me an insight about stop hunts that it solidified a concern I had that validated it for me. Because if these people are writing a book about it, then they saw it too. So if they saw it too, then hey, man, to me that validates it. It wasn't something that I'm just feeling like it's it's limited just to me, which in trading can trick you. But if it's a large sample set of data suggesting something that's there, then the premise is probably having weight to it. Knowing how a turtle soup will form before it forms, same premise. A turtle soup can form right before a macro or just after a macro begins. But knowing the narrative of how that daily candlestick is going to form a down close day or an up close day is going to be understood based on where the liquidity is and how we start the day. Is it going to rally first and create the high of the day, or is it going to sell off initially, trick people short, leaving relative equal highs that they run for later in the day. That creates the high of the day. And the only thing they're really running out is the engineered buy side liquidity. Then send it lower for the close. And that's your narrative. That's the bias is short, but it isn't always open, go straight down, close. How we trade initially after the opening. Because in a perfect world, what we want to see is when we're bearish, it opens, rallies up, and takes out the liquidity above 7 to 9 o'clock in the morning, or London high, or Asia's high. And we use the economic calendar to bridge that. Which one do I really want to focus on? But we always, every single day, use the liquidity that's formed just after 7 o'clock Eastern time, prior to the 9:30 opening bell. Those pools of liquidity cannot be hidden from you. And when it's a clear, obvious relative equal high or relative equal low, and it would match how the daily candlestick should form for the purposes of Power 3. In other words, you're bullish. Your bias is bullish. You think the weekly chart's going to keep working towards a level higher. Okay, wonderful. That means you're going to be looking for easy bread and butter idea is at 7 o'clock in the morning, go to 9:30. At 9:30, in that last 90 minutes, where is the relative equal lows? If there is no relative equal lows, just find the lowest low if it's a singular low. That's where you're going to expect the price to drop down in a perfect world. But because we have to watch and see what the opening range can do for the first 30 minutes, unless it just does exactly what we're expecting right out the gate, which is a Judas swing, and when we're bullish, it drops down and goes for the liquidity. Then you know what you're waiting for. Go down there and get it, soup it, use the first resistance fair value gap that you come to after it runs the liquidity. Okay, it's a little variant on the gauntlet. It doesn't have to have a breaker there. Okay, so running it, I just slip that in there, and people that didn't stay on, they didn't hear that. But the raid after going down to hit that sell side, even if it's going to go lower, the chances of you getting 50% of that drop down, that many times can be a trade. It can yield you 20 handles. It could yield you, and in today's volatility, it could be as much as 50 to 100 fucking handles. You know, it's relative to what you're seeing in terms of volatility at the time when you're looking at the market versus, well, guessing what it's going to do. Yeah, there's a process of you determining what liquidity it should reach for. Perfect world, it drops down for liquidity, makes the low of the day, and then all day long, the rest of the day, it just keeps going higher. That's a perfect classic buy day. They happen about 4 to 6 times a year. I'm sorry, a month. Every other day might get like you're bullish, your bias is bullish. The weekly chart you're calling for a specific premium PD array, and then the market rallies first. Well, that don't make any fucking sense. Like you want to see it drop down. I mean, what do? You wait. And then if it's left relative equal lows during the opening range, it's going to come back down for the silver bullet to get that. And then run higher going into the lunch. And then whatever short-term high that's in the middle of that run, it'll bump down into that during the 2-hour lunch period, hit that liquidity, and then expand for the rest of the day, give you the classic up close when you're bullish. There's only a few scenarios that's going to pan out. There isn't dozens, okay? If the market's going to close high or close low, there's only 3 scenarios that's there. 3, that's it. Experience is going to dictate how those 3 scenarios look and narrate that price being delivered for the daily candle. That's it. That's how it is. The only caveat to that is it's going to start off as it should, and then it goes into seek and destroy. And that's always the wild card. Well, guess when that usually happens? The week of PMI. It's the week of non-farm payroll, FOMC rate announcement, CPI number. That's it. Nothing else. Nothing else invites the seek and destroy. So you may not know if it's going to rain today, but you can identify when the clouds start forming, okay, where are we at on the economic calendar? This could become seek and destroy. So if you made money and things start looking stupid, turn your charts off. Isn't that easy? That's easy. Everything has a process. Everything has a place and a time for it. And you have these rules and these processes and protocols. It removes all of that fear of missing out. It removes all that greed. I have to have a winning trade right now. It removes the necessity of you being right every single time. It gives you the strength to know that what you're using is sound logic. It is not to do away with, well, throwing the baby out with the bathwater. That's usually what happens. And the long and short of it is until you place yourself in front of the charts and you submit yourself to it, you won't see these things. You won't benefit from it. It just sounds like mumbo jumbo, blah, blah, blah. All he does is talk, 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 talk. I'm walking it this year. I'm doing it right in front of you. Can you imagine? Can you imagine every single time I come out here, what I say is expected to happen in the price, and it did the exact opposite of that? How fucking embarrassing. How telling. How revealing would that have been? Then all of you would have had every reason to believe the bullshit that people say about me. But you don't have the luxury of seeing it that way, do you? You have the opposite. You have the terrible discomfort and argument of, well, he's getting lucky every fucking day. But eventually what's going to happen is, yeah, it's delicious. I love it. But anyway, I just realized we've been talking for a little while. Yeah, looks like it's we're in the macro, 950 to 1010 macro. I guess all you guys should be woke up now, and most of you probably will be afraid to see the length of this one. So at least we started at 4 o'clock, and it's like 6 hours, isn't it? 6 hours. Is that the longest I've ever done? It doesn't feel like it's been 6 hours. You want to go for 10? Let's just fucking go 10. 10 hours, only the strong. But fuck that. I got shit to do. I got to get out of here. I got things I got to be at 11:30. So I had fun talking to you today. I was inspired by the bullshit talkers like I always usually do. You guys try to defend me from them, and you always think that like they're hurting my feelings. But you should be thankful because all those people that talk shit, all those individuals that talk shit and talk out their ass and they lie and they think they know something they don't. And when I see that stuff, chances are it's going to inspire me. And like rocket fuel, like it inspires me to set the record straight and say, here's what you are really talking about, but should be talking about. Here's what you're ignoring. And when people take a stop and they've listened to this and they've been a student of mine, and if you've been listening to other people blow beat about bullshit that ain't true about me or whatever, it'll wear on you because you don't have the experience to say, yeah, I ain't listening to that. It's horseshit. I've been around him long enough to know that this is not what he is and this is what he's doing, and I've seen it in my own hands. That's experience that nobody can pay for. But they inspire me. I don't look at them as, oh, they're hurting my feelings. Like, I love it because I can come out here and remind you this, that, and the other thing, and you can't cancel it. You can't argue against it. It's not like I'm not telling you before it happens. Look at the week. Look how we traded inside that range of non-farm payroll Friday high. We were aiming initially for Thursday's high of last week. And we used that daily fair value gap that was bullish. I shaded in yellow. I said no close below keeps it valid for it to send price higher. And we spent most of the week doing what? Reaching up. Now, a apt pupil, someone that's really interested in wanting to learn, they'll go down into the 15-second chart and look for every relative equal low when it formed and when they ran through that and then sent price higher. And that is your everyday model. That's your everyday deliverer. Every time you get in front of the charts, you're looking for that. And that forms every 60 minutes. You got to know what it's reaching for, though. You derive that from a weekly and a daily chart minimum. Nothing less than a daily chart. But primarily, you want to use a weekly chart. What is it reaching for? And every relative equal low on a 15-second chart, once it's rated, if you take the first presented fair value gap, after that, you have a high-frequency trading algorithm right there. For a short-term high or relative equal high or any inefficiency above it, that's your first partial. And then you hold it and see if it can start delivering to that higher time frame target. And then if it does, once you get up to 11 o'clock, if you can afford to take a partial, do so. Because you might have the lunch hour, which is really 2 hours long. It could retrace and go even beyond where you got in at and shoot for a London low, upset the people that are in there long. That's more likely to occur if you're in the discount area of that primary range that you're expecting to see delivered on a daily or weekly basis. In other words, that draw liquidity that you're aiming for bias purposes, when you're in the first half of that price run that would materialize, there's going to be stop hunts like that will occur. So you have to trade differently a little bit there. But when we get to a premium side of that price run, you won't see these big drop down. They won't need to come down there because they want to get closer to that exit strategy of getting out at that pool of liquidity or that inefficiency that's a premium